Our market guest is with us actually now. Gautam Trivedi joins in from Religare Capital Markets. Gautam, hi, good morning. What a great day to have you with us, and what a great moment actually to have you. The Nifty just hit 8600, another lifetime high.
Yep.
Do you get a sense that this really is that mother of all big bull markets, and this is just going to keep making new highs? And what's your own target now on the Nifty and the Sensex?
I think we've basically surpassed our own target, so I think the new target is something which my strategy group will have to put together. But the reality is that I think if you look at it from a bull market perspective, that's the term you used, I think we are already 10 to 12 months into a 5-year structural bull market. That's the belief that we have at Religare. And that's the way we've been approaching and telling and advising investors.
Okay. Gautam, I'm not going to put any Nifty targets at you, but when you say it's a 5-year structural bull market and we're already 12 months into it, 5 years down the line, what will be different for the Nifty? Will we see a sustainable macro difference that we'll be living with, a new macro normal? What's your 5-year story?
See, I tell you where we're coming from. If you look at the previous bull market, what were the characteristics of the previous bull market, which began, let's take the starting point of 1st of January 2003. It may have started a few months earlier, but let's look at that 5-year golden period, 1st of Jan 2003 to 31st of December 2007. The Nifty went up 450%, but the CNX Midcap Index went up as much as 850%. Within the CNX Midcap Index, which is comprised of 200 stocks, 111 stocks rose more than 500%. Now, outside of the CNX Midcap Index, there were other stocks as well that actually went up. So when you start looking at the way these stocks actually have moved up, it's fueled, of course, by fundamentals. Interest rates were at their peak and started coming down. We're pretty much at the same spot, same situation now. The difference, though, is that the last time, all 5 cylinders were firing at the same time. And when I say 5, I'm referring to FIs, private equity investors, domestic mutual funds, domestic insurance companies, and domestic retail. So right now, we are in a situation where we still have the FIs firing all cylinders. Private equity funds are starting to warm up again to India. Mutual funds are starting to now turn net positive versus a net negative in terms of their inflows and outflows. So redemptions have clearly stopped for the most part. But again, it's not a huge number. And then finally, you have the insurance companies, which unfortunately are still selling. And then last but not the least, you've got the retail investors. So the retail investors are again inching back and coming back into the market. So I think we haven't seen the full effect of all 5 cylinders firing at the same time.
Oh, Gautam, that's interesting. In that case, if we do start to see all 5 cylinders firing, and if we were to repeat the kind of market behavior that we had last time around, this year, of course, the mid-cap index has outperformed, but is up 54%, and the Nifty is up 38%. That's a really powerful course, really, if you're talking about a bottom-up stock market approach. From here on, what kind of gains can we expect in the broader market then?
Well, I don't want to again, forecast where the market's going to be 1 week, 1 month, or 1 year from now in absolute terms. But like I said, our focus as a firm has been in midcaps. We are very, very strongly midcap focused. In fact, we have our Delhi midcap day today with 15 companies, 45 investors. So the demand, as you can see, is massive for midcaps, and that will continue. But again, I don't want to talk about where the CNX midcap index is going to be. I would rather focus on bottom-up stories, and that's really what the midcap investing is all about.
So give us 3 or 4 names that you're most bullish on from bottom-up perspective.
Sure. I can give you 2 right now, which I think are fairly current. One is Ashiana Housing. They're actually with us today. It's a great story. It's the only listed pure play mid-income housing company. They have projects in cities which are tier 2 and tier 3, Bhiwadi in Rajasthan. They're in Labasa, where they have actually built the first ever senior citizens home, and again, a very successful model. They are also present in Jaipur, Jodhpur, Jamshedpur, and Halol in Gujarat. So again, venturing out into interesting cities and towns. The other one we like is Sanghi Industries, which is a cement play, a pure cement play, capacity going from 3.1 million tons to 4.2 million tons by early next year. And on a EV to EBITDA, it's only 4.5 times, which is extremely cheap, even within the mid-cap context. So these are 2 stocks that stand out, and we like them from a mid-cap perspective.
Okay. Gautam, I'm just going to get back to the markets and ask you another question. Would you be worried about the pace of the increase that we've seen for the Nifty? This is something that Anuj and me were discussing a couple of minutes back. It's 850 points from the 16th of October itself, and we're at the end of November already. Does the pace of the increase worry you?
You know, yes and no, it does. But the thing is, let's look at what's causing it in the first place. In some sense, has the Modi government done a stellar job of justifying where the market is today? I think they've done a good job. The fact is, any government that's been out of power for over 10 years needs at least 12 months to figure out and get its hands around the fiscal and economic situation of the country. So I think we need to give them some more time. What they've done so far have been, in some sense, baby steps, but I can see more and serious and bigger reforms coming within the next 6 to 12 months. So that is one. So in some sense, the market has run up ahead of the ground reality. We have a large NBFC business, and when I talk to the CEO of that business very so often, he says the fundamentals are starting to improve, but he hasn't seen a dramatic shift as yet. So in that sense, the market has run up ahead of itself. At the same time, you have Ashok Leyland, which has been reporting, actually that would be one of my other mid-cap picks, but anyway, Ashok Leyland has been reporting stellar numbers for its medium and heavy commercial vehicles. Now, why would anybody go and buy a 30 or a 40-ton truck if the underlying business and the economy was not starting to improve? Again, the numbers are not huge, but the fact is you've seen 3 consecutive months of Ashok Leyland posting stellar growth in their medium and heavy commercial vehicles. So I think that's one side of it. The other side, which of course is driving the market, is the absolute and sheer fund flow. If you look at India from an emerging markets context, let's think of which other emerging market would you guys, sitting in the studio, think about it. Would you put money to work? Would you put money to work in Russia? Impossible. Would you put money to work in Brazil or Argentina at this point? Very unlikely. China, still slowing down. They just had a rate cut. Not sure if that's going to spur growth. But the fact is, again, that's a market most people are underweight on. So India stands the tallest among the emerging markets. And obviously that also reflects with our currency, which has also been one of the strongest among the EMs.
Indeed. Gautam, a word on PSU banks. In fact, we just were seeing some flashes from the Minister of State Finance, Jayant Sinha, talking about possibility of reducing stake in PSU banks to 52%. That's something that the government is now considering. And has been considering. We've seen a big move already on PSU banks, Gautam, to be fair. And this morning that's continued. The bank index is up 5%. But from here on, how would you approach PSU banks?
Well, I think this is a very specific incident that's driving, or not incident, but a very specific reason if the government is indeed looking at divesting and bringing the stake down to 52 or 51%. So that is specifically the case, but the preference from a institutional investor perspective still remains largely with the private sector banks. So if you ask the average fund manager out there, whether he's an FII or domestic, the interest remains for the most part in private sector banks because they're concerned about the NPL issue at the PSU banks.
Okay. Gautam, I was looking at a couple of your picks. You mentioned Ashok Leyland. That stock has already given returns of around 200% on a YTD basis. Do you think that maybe the next fiscal or 2015 would be as beneficial for the likes of Ashok Leyland and we could see incremental gains from these levels that it's already trading at? Or my question is that do you think that they've already seen the best in terms of a run-up?
I think, no, we have not seen the best. In fact, our target price remains right now the highest on the street at 65 rupees. But I'll tell you what the story on Ashok Leyland is. And we identified the stock back in November of last year when the stock was trading at 12 rupees. And the company basically incurred huge debt of about 5,500 to 6,000 crores in putting up a brand new spanking facility in North India. But the problem was the commissioning of the plant coincided with one of the worst recessions in the country. So high costs and high debt, and obviously sales were obviously not growing. So the company, what did it do? Okay, they realized and said, okay, we have a problem. We've got so much debt. How do we go about in a structured manner reducing this debt? They began selling assets. They cut costs in terms of number of employees. They also took pay cuts across the board. The senior management took a 20% pay cut, which is remarkable. You don't see that happening very often in corporate India. And I think they made a very concerted effort and a timetable of how to reduce their debt, which they've started delivering on. So I think you're looking at a company where the debt actually is coming off. The underlying economy is showing signs, as I said earlier on this show, for the past three months, they've had stellar medium and heavy commercial vehicle sales. And if the economy continues to rev up and growth comes back to 7, 8, 9% over the next 3 years, this stock undoubtedly will do very well.
Okay, Gautam, today's big run is because of what's happening to crude prices. But what's your call on oil and gas space itself? Do you think stocks like HP, BP have more to go? And more importantly, what's your call on a stock like ONGC?
Yeah, I think we like the oil and gas space for the most part. ONGC, I think, was also, every drop in the price of crude oil globally, means less subsidies, and that's obviously better for ONGC. So we like ONGC. We like, even now at these levels, BP and HP. So we continue with that.
Okay. Gautam, one last question from my side then, and this is referring to 2015 again, because as an investor or a new investor would want to know, what would be the big idea that would give you that maybe 115% return that BPCL has given in 2014 YTD, or maybe the Bank Nifty, which is given close to around 60 or 60+%. Which is that big idea that you would be propagating into 2015?
Well, I would focus on a mid-cap, and I think the one mid-cap that we like would be Ashiana Housing. We also like, actually, Sanghi Industries. Our target price is 90 rupee, stocks at about 44, 45. I don't know, I'm in Delhi right now, so you probably know what the latest price is, but we have a near 100% upside on Sanghi Industries. So I think that's one stock which we believe strongly will do very well. And cement as a sector, we are overweight on anyway.
All right, Gautam, we wish you luck with your conference. Thanks a lot for joining us on a strong day for market.